Hello, in this particular presentation, we shall look at the advanced analytics modules for the what we have developed for the inventory analytics. So we look at the data is designed for inventory, which is being used for merchandise planning, assortment, category optimization, inventory planning. The inventory planning module has features related with trends and seasonality, promotion, lost sales, ABC classifications, and inventory level projections. First, a data model, which is the standard data model. So we have a vendor, which is a one-to-many relationship with the voucher. So at the voucher level, we have the fixed order cost. Then we have the Godaam. So we incorporate the hierarchies here using the parent Godaam hierarchies. We have category, stock group, manufacturer, each with a foreign key at the item level. Then you have the item dimension at the item level, and the valuation type is FIFO, LIFO, or moving average, or whatever. The item description is defined by ABC classification. So basically we have an ELT process which will be, so item description ABC is calculated after you calculate the valuation of the cost of goods sold, which is done using FIFO, moving average, or LIFO. And that means since we are doing it at the voucher level and the item level, therefore that means we are doing a perpetual cash calculation of the inventory. Also we have the purchase and sales. These are the composite keys. So these are the inventory valuations for perpetual, FIFO, LIFO. We have periodic moving average on a daily basis because of the fact that many times the sources do not have a timestamp. So these are the complications with which are addressed with regards to Tally. So we just skip all of them and we straight away go down to the advanced analytics module, with regards to the inventory management. So basically in the inventory analytics, we look at when to order for a set of items. Does the client have adequate inventory of items? Which items are overstocked? Which items need to be purchased immediately? And at what price to reorder? So first of all, the gross margin analysis. This is straight and simple. Since we have calculated it, the gross margins using FIFO, moving average, and so forth. So wherever it is negative, we have made a loss. It's less than 0. We can also set up a gross margin percentage wherein we find out where we have made a loss. That can be used for space planning, assortment planning, price and markdown planning, and so forth. This is actually from one of our clients. So this basically gives that how many percentage number of transactions had a gross margin below 30% on a year-wise basis. It says in 2012, 97% of transactions had a gross margin below 30%. Similarly, and then you can drill down from here. Similarly, what is the percentage revenue associated with transactions with gross margin below 15% for these 5 months of the year 2012? So it is given by, say, 20%. These kind of LRTs can be done. We take only the retail invoices and we then get the markup margin, and we work around with the markup margin to work around scenarios which are involved in product phase out. Then we sort the cost of goods sold in a descending fashion, and we depending upon the prompt values and on the branch, we basically can get the top 60%. So that's the A, then the B, and the remaining ones are the C. We can also track the historical changes in categorization and based on the prompt values. So again, if the stock to sales ratio as given here is above the 4 and it is between 3 and 4, then it's the right stock. If it's above 4, it's overstocked. If it's below 4, it's understocked. So straight away the scenario is where it's overstocked, then you need to transfer the material to the understocked. So therefore the company can save a lot of money. So for this particular analysis, we had used the monthly aggregates. Now for the stock optimization, this is a typical problem. So I have a branch, I have the current stock, I have the stock to sales ratio. That means it's overstocked at the branch 1, and branch 2 and 3 it's understocked. This is my optimal stock ratio. So what we have specified is that the stock to sales ratio should be between 1.5 and 4. These are the constraints. I need to maximize my gross profit. This gross profit includes my gross margin minus my shipping costs from branch 1 to other branches, and we have to simulate these values for the number of units which should be at the branch at the end of the month for the given client. So this is a typical stock optim. This is a complex dashboard which we have used. So basically for this dashboard, we open the reporting tool, we set up prompt values, and within the prompt values I set up the date parameters, the from and the to dates, the type of valuation, and then what will be my A category inputs and B category inputs. So I might say 65 or 25, or I might say 70 or 30. And based on that, I have got stock to sales ratio average over the given period in time. If it's above 4, then it's marked as yellow. If it's below 3, then it's marked as red. And then I can drill down to the item level. Then similarly, I have got sales percentage distribution by category. That means at category and then the item. Then I have the number of items, A, B, and C again, and then similarly the gross profit. Then how much to order? So basically we are looking at trend year on year and seasonality quarter by quarter. So we looked at it on an average 3 to 5 years period, and we are basically, so say I've got a sales graph like this. I do an exponential smoothing, which is a standard process, and I get my mean square error. So I basically get an error. I calculate the mean squared error, and the method which we had used was to minimize the mean squared error over the given period in time to actually arrive at the seasonality index. That seasonality index translates to the breakup of the sales here. So you can drill down from a quarter down to a month. We had currently used Solver for the same. This is for these particular category A items. I have a base case scenario usage. Then I can say it's minimum here, the maximum here, most likely here. My total budgeted was here. So I have a 18% chance that actually I'll meet my budget if I plot the usage on a normal distribution curve. My most probable value is 18,963, and for 95% chance that I'll actually be meeting the target, it's 19,796. Then I look at the issues with regards to safety stock, the reorder points, the sales, and so this is my typical safety stock case scenario. I've taken the 5-year sales, so this is actually taken from the Lockhart formulation, and I have the forecasted sales for these 3 months. It's all assumed to be equal. So I assume that I have got lead time in months of 3. My service level is actually dictated by gross margin. So gross margin is important for us, and the carrying cost, which we'll be also capturing in a data warehouse. And then I look at the lead time demand, which is actually a sum of all the 3. And then the standard deviation is coming out to be standard deviation of all these 5 values. And the inverse, so it's the service factor is actually inverse. So I basically plot the service level on a normal distribution curve, and I do an inverse of that. So it's called norm if. So I get the service factor based on this. And the lead time factor is the square root of this lead time. So if I multiply 1, 2, 3, then I get my safety stock. And then if I add the safety stock to my lead time demand, then I get my reorder point. Again, if I have to look at whom to order, I look at average delivery time across different categories of products. So I have year, category, then I drill down to the item name, average price by name, drill to the item name, average discount by quarter. This is quite basic, average rate of return. So these are complex data to get, but we will be producing all of them. For order cost optimization, what I have is that I have the vendor, so I have the order cost here, the order cost per order. I have the Godaam cost per meter cubed. So this, along with the item dimension, adds to my holding cost, and I have the order cost per order. And this is my typical scenario that EOQ is the cost of holding order, and the space use our standard formulas. And I need to minimize my total costs. I need to simulate the purchase values, and my constraints are that the cost of the products is less than equal to total budget. The total space used is going to be less than equal to the total storage capacity, and the total quantity used is greater than equal to 0. My price per unit is my cost of goods sold. It includes labor, taxes, and freight costs. My purchase cost optimization is I've got a manufacturer, I've got a steel, RMC, and so forth. I need to optimize these purchase values. So my total required is greater than equal to what is what is here, and my and what I get from the particular manufacturer is going to be less than equal to what is available. So I need to minimize my total costs with the same. What happens in a typical real-time scenario is that your demand can actually vary with periods in time. So we have incorporated demand variability scenarios. This is all looking 100, but actually this demand is varying. It's varying on a normal distribution curve. and we have assumed an autocorrelation factor of 1, factor of 0.48. So at AR1, it's actually autocorrelation of factor of 0.48, and at all the other autocorrelations, the factor is 0. So what we have here is so demand is varying. So I need to predict that how much should I purchase? How do I minimize my total cost? So we have used solver for this. Companies using S2S trigger ordering policies. So I have at minimum is 100. I can order up to 600. My beginning inventory is 500. My fixed cost order is 5. This thing. So these are my fixed costs. These are all going to come from the data warehouse, and then I need to simulate these values. Then I look at the lead time analysis, and the lead time analysis, I look at history. So I look at how the history, the lead time has been varying over the history for type A, type B, type C items, similarly price, and similarly for discount. This graph actually gives the time to sell for the inventory and the days to sell. Easy data access. This was the basic graphs and dashboard at 66% service levels, and this is actually giving the safety stock and reorder point with a 95% service value. Thank you so much for your time. Any questions are welcome.